Do you want to learn how to get retired, stay retired, and enjoy your life to the fullest? This is the Retire Happy Podcast with certified financial planner professional Jeremy Finger. Jeremy will be your guide to happiness as he discusses the art and science of retirement, breaking down the complicated information to help you make good financial decisions without worry or burden. Now, on to the show.
Hello and welcome to Retire Happy with Jeremy Finger. Jeremy, what's going on?
Just living life, brother. How about yourself?
Yeah, the same. Just about the same. I know we've got a big topic right now because of the time of year it is, right?
Yeah. We're going to go over a little bit of tax planning, but I'm going to have to say this is a little bit more difficult than normal.
Okay.
Yeah. I started a diet today.
Oh.
Yeah. We're going to be talking about saving money on taxes and what people can do about that. But I just want you to know that this is going to be a little bit more difficult conversation just because I'm hungry.
Okay. Fair enough.
Yeah. Anyway, let's proceed.
Okay. See, now I feel bad that I'm not dieting.
Yeah. No. Don't feel sorry for me. Okay. I ate too much the past year, so I got to pay the piper. Hey, I got to pay my taxes, my health taxes.
So the health taxes are due. Okay.
That's right. That's right. Yeah.
All right. End of year planning is a big deal, right? And I know that you do this all the time with your clients, so it's nothing new for all of us that don't do this on a daily basis. There's a lot of things that are probably new, and all these different changes within the law and the tax codes and all that. This is what you keep up on, and you have pros that help you do this as well.
Yeah, that's exactly right. You know, there's a lot of things that you, after December 31st, that you cannot do anymore, that you really need to do in the calendar year. All right. So when you drop the shoebox full of receipts over to your CPA's office and they're looking backwards, there's only a few things you can do the following year to help taxes this year. And we're going to talk about some of those things today that hopefully can get people on the right track and not pay more than their fair share.
Okay. Where do we start?
Okay. So this is more geared toward retirees and business owners. The first one is qualified charitable distributions. Okay. You know what that is, Eric?
From what I understand, yeah. So you can do qualified charitable distributions from an account, right? So in other words, RMDs are part of this?
Okay. Yeah. Yes, absolutely. So let's say, because all the listeners here have tons of money in their IRA accounts and their 401ks, right?
Yeah.
So what you do is you gift money to a charity directly from your IRA and to the charity. Now you have to be over 70 and a half years old. And you're taking the money out of your IRA directly to the charity, and there's no tax. Now, some people may say, I want to get a tax deduction. When you do the math, because a lot of times people don't itemize deductions. And even if they do itemize deductions, it may still make more sense to do a qualified charitable distribution. So giving money directly from the IRA to the charity is usually the most tax efficient way of giving money if you're over 70 and a half.
Okay. And is 70 and a half when the RMDs start?
No, sir. Not now. Yeah, no. Now it's 72 years old.
Okay.
But for whatever reason, you can still do QCDs at 70 and a half. But let's just say you're 72 years old, Eric, and the IRS wants you to take the money out and pay the taxes on this money. If you give money to charity after 72 and you do a qualified charitable distribution, it qualifies as your required minimum distribution. So if the IRS wants you to take $10,000 out, and instead of taking $10,000 out, you give $10,000 to your charity through a QCD, you don't have to pay any taxes.
Okay. So if I'm understanding this correctly, at 70 and a half, a QCD is pretty powerful to help you with your taxes, but at 72, it becomes even more powerful because you're forced to take RMDs at that point. And so by doing it this way, giving to charity, being charitable, you're actually killing two birds with one stone in a way.
That's exactly right. Yeah.
Okay. All right.
Yeah. It's a double-edged sword, cutting taxes both ways.
Okay.
It's a double benefit.
Yeah.
That's right.
But you don't have to do the full amount. So let's say your RMD is 20 grand. I have no idea. I'm just throwing out a number.
Sure.
And you plan to give 10 grand charity. Can you do 10 in a QCD and then 10, you take your other 10 out like you normally would and pay taxes on it?
Yes, absolutely. You can certainly do that. Oh, by the way, you're limited to $10,000.
Okay.
Yep. Yeah. Excuse me. Not 10,000, 100,000. A limit of
okay, that's
$100,000.
The charities are going, yay!
Yeah, yeah, that's right. You're limited to $100,000 for the QCD per year. So
Okay.
there you go.
Right.
Yeah.
It's a good strategy.
Yeah, yeah. And another thing, so business owners can do, they have this ability. If they're going through a tough year, they may not have a net operating loss, and generally that can go against taxable income. And so obviously talk to your CPA about this. But if you have a net operating loss that's quite substantial and your income is really, really, really low, that would be a great time for you to take money from a pre-tax account and put it over to a Roth IRA. And because your income is very low, therefore your taxes should be very low. And you can take advantage of that by converting that money in a low tax bracket year for you. So that's something that some business owners may want to consider doing. And you got to do that before December 31st.
Okay. Makes sense. So they should be getting on this now.
Yeah. Yeah. This is, we're coming up on November. So yeah, you need to get on that.
Yeah. I'm sure the CPAs are not going to be answering their phone much when come 1st of December because so many other people have already called.
That's right. But not, our listeners are smart. They're on top of this. They're getting ahead of it. They are making all the right moves.
We have no procrastinators in our audience except
we do not.
Your co-host.
I have to say, me as well. I probably should have started this diet 8 months ago, but I didn't.
You started one.
This is true.
One.
This
I'm still procrastinating.
But you look fantastic though. That's why. Yeah.
Just because you can't see below my chest. The camera hides the belly. Something fierce, my man.
That's right. Oh, it brings up to another thing that some of the retirees can do is a lot of times retirees may be in the retirement tax valley, as I like to call it, even though they made a lot of money in their pre-tax years or in their working years, and then once they retire, they may drop down into a lower bracket. And so be like lower to middle income because they no longer have earned income. And then they can fill up the lower tax buckets by doing Roth conversions. Again, taking pre-tax money and putting it into a tax-free Roth IRA.
Okay. So when you say fill up the tax bucket.
Yeah. Okay. So
up to a certain amount, because then you're in the next tax bracket.
There you go. Yeah.
Okay.
Yeah.
All right, that makes sense.
Yeah. So if you're in the 22% bracket or 24% bracket, be mindful of converting enough to where you're not jumping up into the next tax bracket.
Yeah.
Yep.
Because you can do it every year, right?
Yeah, absolutely. You can do it every year.
Small chunks every year, and that makes a big difference over the long run.
That's right. I like to call it retirement tax arbitrage, meaning that, hey, I'm going to pay 15% taxes today versus 22, 24, 36% later.
Yeah.
Yeah. Okay. So it's like buying your straw hats in the wintertime, as Warren Buffett likes to say.
I haven't heard that before, but that makes sense.
Yeah. But my question is, who's buying straw hats?
Okay. I've got too big of a head for those things.
I digress. And so there's another couple things that people can do. They can fund HSA accounts, health savings accounts. That's a really good thing. You got to qualify for that. You got to have insurance that is under a high deductible plan that qualifies you for a health savings account. And it's triple tax beneficial. You get a tax deduction on the front end, grows tax free, comes out tax free for any qualified healthcare expense.
Okay.
And so really it's the best of all worlds, really, for those that qualify.
HSA is only during working years?
If you have a health insurance that qualifies for an HSA,
okay,
and you're under 65 years old,
okay,
you could qualify for a health savings account. And guess what? You can put that money in and you get those tax benefits and you can invest that money. So let's just say you're 30 years old, 40 years old, 50 years old, and you got a health savings account and you're smart and you're not taking that money out. So many people put the money in and take it out the same year and use it for healthcare expenses as they go. Don't do that. Use your regular money to pay for those expenses. Let this money grow over time, tax-free, and come out tax-free for qualified healthcare expenses. And so you can save receipts indefinitely. So let's just say you had a medical procedure at 35 years old and you were smart and you invested this money up from 35 to 65, at 65 years old, you needed some extra money, you could take your 30-year-old health receipt.
Really?
Take the money out. Yes. Tax free. Yes, absolutely. You can do that.
So what happens when you turn 65? Is this money converted into a different type of account, or are you still able to, what happens to it?
Okay. So that's good. That's good. You think of it as like an extra Roth IRA. Yep. That is a bucket of money that you can take tax free at any point in time, up to the amount of healthcare receipts that you have in your shoebox, or hopefully you're holding that digitally somewhere where you can, you can reference that and share it with your financial advisor and CPA and things like that.
But what I'm asking is, at 70 years old, can you use this for ongoing healthcare needs, maybe long-term stuff, or?
Yeah.
Okay. So that's what I was concerned at 65. It had to be converted to something, but you're saying it's still an HSA. It's still being used for healthcare. So if you need, my father-in-law, for instance, had a fall, right? And he twisted his back, and he actually went into a short-term care rehabilitation center. So he was there for 6 days.
Yeah.
So you could use it for that.
Yeah, absolutely. Yeah. Did he have to pay any money at all?
He did a little bit, but not much. So he didn't have to worry too much, but it was still probably, I think it was like $3,000 total for that entire thing, even though I'm sure the bill said $150,000, $200,000. He only had to pay about $3,000, but still that $3,000 could have come out of the HSA.
Yep. And tax free.
Okay.
Yeah, no, it's really, really good. And if you think about all the health care, from prescription drugs to you name it, all these expenses that you're paying for throughout your life, just to keeping those receipts, and those receipts are a get out of tax free card.
Seriously.
So to speak.
Yeah. It's almost like it feels like a debit card. You're putting into the machine, but it's just, you just put the receipt in and take the money out.
That's right. But you want to do that later so that, it
has a chance to grow.
So it has a chance to grow, and you can invest that according to what your needs are and things like that. Yeah, that's right. People can't do it after age 65. So people who are,
you can't put in. After
no,
65.
You can't. That's right.
But you can take it out after.
That's right. But just make sure your health care insurance qualifies you. So you have to have a high deductible health care plan that qualifies you for an HSA account. Okay. So that's very, very beneficial. Also, if retirees are going back to business owners or retirees, if you fall under a certain tax bracket, you actually take capital gains and pay zero tax. Capital gains don't kick in to any tax bracket until, if you're joined, and this is in 2022, to a little over $83,000. So if you get combined, married, filing jointly, $60,000 worth of income, you could sell some stock, let's just say, if you have a gain in it, and pay zero tax. Okay. Yeah. So that was very advantageous to do. I was on a 3-way call with a CPA one time. This guy, he had a lot of money in an individual stock that he held for a long, long period of time. And I coordinated some strategies with his CPA, and he was able to sell $60,000 worth of that stock and pay no capital gains on
it. And because it doesn't count as income either. So it's not like it's adding to your income, right?
Yeah, you want to make sure that the amount of capital gain that you do take does not push you combined above a certain threshold.
Okay.
And that would then make that capital gain taxable.
Got it. So in other words, talk to a professional before you make those moves.
There you go.
Give them some contact information at the end of this podcast.
That's right. We'll do that.
All right. What's next on your list, man?
Okay. Tax loss harvesting. I think a lot of the listeners that know about that. If you're down on an investment in a taxable account, you can take that loss against any gains that you have, and reinvest that in something similar. XYZ to DEF fund, XYZ fund to DEF fund, a similar one, but a little bit different. And so you can take that loss and you can reinvest it immediately in there. So if the market comes back in that particular type of area, you can participate in that as well.
So let me ask you this, because XYZ and DEF doesn't mean much to me when it comes to funds. But so let me ask you this. Can you sell Microsoft stock, right, and then buy Apple stock? Because they're similar, but not the same.
That's exactly right. That's exactly right.
And I'm not endorsing.
No, I was intentionally avoiding naming a name.
I'm naming names because I'm a concrete thinker. So for anybody else, you could sell a tech stock and buy another tech stock.
Yes,
it's similar but not the same. You
go.
I don't know, like a GE and then sell it and buy something similar. I don't even know what's similar to GE.
That's right.
But I see what you're saying.
Yep, that's exactly right.
Company.
That's exactly right. Yep. There you go.
Okay.
Some other things that this is a little bit off the tax realm, but review your beneficiaries. I've seen people get remarried and have ex-spouses as their beneficiary. That's not good.
That's not a conversation.
No,
Can you
it's
imagine
not.
that conversation?
Yeah.
With your current spouse. Oh, by the way, honey,
No.
It's one way to get her not to kill you.
Yeah, that's true.
If the ex-spouse is the beneficiary, you're guaranteed a little bit more lifetime.
You know what? You might want death. You may want death.
At that point, it's a crapshoot, really.
That's
it's just
right.
like it's a 50-50.
That's right. That's where a smart financial advisor pulls the person to the side. Hey, buddy, you may want to do
quietly, right?
Yeah, here, sign.
Let me talk to you in the hallway real quick.
That's right. That's right.
Oh,
but yeah, and hey, same thing for insurance policies, old 401k accounts, and things like that.
Yeah.
So
my wife wouldn't kill me in that case. I don't have an ex, but she wouldn't kill me in that case. But she'd probably really make sure. You've met my wife. She'd make sure that I couldn't walk straight for the next couple of weeks.
Yeah. You may wish death is what you're saying. So you may wish death if some things like that. Yeah. Well, see, that's one thing about making sure you got a good overall plan is that there's a checklist of things that you go through to make sure everything's on the right track. Okay.
More importantly, you have somebody that is looking at your plan for you and with you, because I can have a great plan, but I don't know what to look for all the time. And like you said, you just don't know that your beneficiary was your ex, or when you're younger, maybe your beneficiary is your mom and mom's passed 10 years before.
That's right.
You got somebody like you who's going through this checklist that we just don't know as a layperson.
That's right. That's exactly right. So really and truly, hopefully our listeners are living their best life.
Mm-hmm.
Okay. They're traveling the world, or they're planting their garden, or they're attending kids and grandkids for baseball games and things like that. And so that the burden of making sure that these decisions and these things are in place is on their trusted advisors.
Absolutely.
Okay. At least that's what we do. And to make sure that we periodically go over things and making sure that things are on the right track. And I had someone this morning, a client, and he had an old, this thing was from 25 years ago. And he had a little bit of a pension over there. And so he was trying to decide on, And so he was trying to decide on, hey, do I do life only? Do I do life tenured certain? Do I do life with 100% spousal benefit? And so there's different dollar amounts associated with each. And so talking through those options, he's like, hey, what does it mean to life tenure certain? It means, hey, buddy, you're able to get that benefit for your entire life. But if you kick the bucket next week, your spouse is going to be able to get it for the remaining 10 years.
Oh,
yeah.
I never heard that before.
Yeah, that's right. So, and see, here's another thing that people don't know. And I had some people on a webinar ask me this question, but I don't think they got it when I was emailing back and forth with them. But so a lot of times you may have a lump sum of money in a 401k, and they say, hey, yeah, you can take out X number of dollars. You could roll over $500,000, let's say. Okay. And this is just an example. Mm-hmm. Or we'll give you, I don't know, $60,000 a year for life. And they go through these same options, 10-year certain, or with a spousal benefit. And there's a way that you can figure out what interest you are getting on that money. Hey, is it better to get a lump sum of $500,000 or $60,000 paid to you over the course of a lifetime? And comparing that out, you can see what the internal rate of return they're actually are giving to you on that income.
Yeah.
Okay. There's calculations that can be done. I've seen many instances where it makes sense to take the lifetime income. And I've seen many instances where it makes sense to do the rollover. Okay. Next on the list after checking your beneficiaries, Eric.
Yeah, the checklist. Do the checklist.
Yeah, that's right. That's right. You could is if you're giving money to your kids or grandkids, do so before the end of the year. In 2022, you can give up to $16,000 per person. Yeah. So husband gives 16, wife gives 16, little Johnny gets 32. Okay. So you can combine
little Johnny, if anybody's out there wants to give 32,000.
There's a lot of jokes about little Johnny. Was that?
Yeah,
that's
true.
probably
I don't want to be little Johnny. You're right.
That's probably because of you, right?
Example.
That's right.
You just set me up, didn't you?
I did. You bid it too. So I
did. I totally fell into
I was reeling that in. Yeah. You took that hook, line, and sinker. 16,000, what you can give little Johnny per person, right? Now, the cool thing about a lot of grandparents do is they get, or parents, is they put money in a 529 plan, and that money goes in and grows tax-free, comes out tax-free for educational expenses. And so for qualified educational expenses. So it's very advantageous. Now, in some states, like we're in the state of South Carolina, you can get a state tax deduction for the contributions. So if like someone's going to private school, I went to private school, PD Academy in Marion, South Carolina. And so let's just say I'm paying $5,000 for that every year. The best thing to do is put it in a 529 plan and take it right back out of the 529 plan and get your state tax deduction.
Okay. Sorry, what? Say that again?
Okay. Back that up a second.
Yeah.
So let's just say, for instance, that little Johnny Jr. is going to private school. Let's say he's in 8th grade.
Yes.
And the tuition's $5,000. Instead of writing the check directly to the school, just set up a 529 plan, put the $5,000 in the 529 plan, take it right back out and get your state tax deduction because you contributed to a 529 plan and you get it right back out.
So you're saying the contribution that goes into the 529, is that before tax money?
That's after tax money.
So but
it's almost like you don't get a federal tax deduction, but you can get it. And some states may offer a state tax deduction.
Okay.
I'm following which is not a huge amount, but it's not nothing.
It helps.
I mean,
yeah.
The state of South Carolina is 7%. So you put in $10,000, you might save $700 on taxes. I obviously talked with your CPA about that, but
$700 is a heck of a night at Red Lobster.
Wow. Red Lobster?
No, I'm in the middle of the country. That's the best I got.
Oh, is that
South Carolina, you got all sorts of options. So what would your pick be? Not Red Lobster. Where would you go? $700.
Oh, I might go to all you can eat crab legs over at Restaurant Row.
Seriously, a place like that right near you?
Oh, it's 2 minutes away.
And you're on a diet.
I wear my stretchy pants.
You're on a diet. What are we going to do?
No, I can't. I don't go there.
Seafood diet.
I don't go. Yeah, any food I see, I eat it.
That's right. That's what I'm on right now. But I don't see any seafood around me.
So cool thing about, let's get back to 529 plans, is that also is not factored into the FAFSA process.
Nice.
Yeah, that's right. Yeah.
That's huge.
Yeah, it's a big deal, meaning that if your little Johnny Jr. is looking to get a scholarship or something like that, a lot of those assets do not qualify towards that. But if they take money out and for expenses, their income may be associated with that. But again, talk to your CPA about that. Also,
so let me ask you a question real quick on that. Yep. Grandma, grandpa, aunt and uncle, neighbor who loves that kid dearly because he mowed his lawn for years. They all want to contribute to this 529 plan. Can they do that?
520, yeah, that's right.
So it doesn't affect, let's say mom and dad don't earn a ton, right, in income. So maybe they're going to qualify for a Pell Grant or something to that effect. It won't affect that because it doesn't show up on the FAFSA is what you're saying. That's
correct.
So then it's only when you pull money out that it could become an issue when it comes to income.
That's correct.
Okay.
That's pretty good. Yeah, that's correct. I had a friend of mine ask me yesterday, hey, if some of these employers offer, paying off loans, student loans. Yep. Okay, that might be part of their benefit package. But obviously, if you don't have a student loan, they're not going to give you that as a bonus typically. He says, in the event that one of my daughters gets a job and the employer doesn't offer to pay off the loan, can I use some of the 529 plan to pay off the loan? So what his thought process was, hey, borrow a little bit of money. If it gets forgiven by the government, great. If it gets paid off by the employer, also great.
Yes.
But in the event that it doesn't, can I take some money out of these 529 plans to pay down the loan? And it says, yeah, you could take up to $10,000 to repay student loans.
Per year?
I do not know. I do not know if that's per year or per child. I'll find out and I'll put that in the show notes.
Okay. Yeah.
Does that sound good?
Yeah. Yeah,
Yeah.
absolutely. Because either way, it's a fantastic benefit. It'd be better if it was per year.
Yeah. Yeah. I mean, it would be. Then
Just
you're
keep
really
pulling out
talking.
of there.
That's right. That's right. But also, you could take money out for qualified apprenticeships and things like that too. The rules of being able to take money tax free out of a 529 plan are pretty darn flexible. You could even include some off campus housing. So
See,
let's just say the cost of living in Columbia, South Carolina is $1,000 a month.
hmm
Well, on campus, they may be able to give you the equivalent to live off campus. So you could take $1,000 a month out for off campus housing.
So worst case scenario, because I've heard 529 plans been around for a long time.
Yeah.
I know that people's concerns are my kid's 5. Little Johnny's 5 years old. We're starting to put into this, so on and so forth. Little Johnny decides that he doesn't want to go to college.
Sure.
And maybe he picks up a trade, right? And an electrician, and he gets an apprenticeship. And there's just not a whole lot of cost for him as far as schooling is concerned.
Yeah.
What happens if? And I know that there's rules for a second child, right? If you have another child, little Jimmy, that's 3 years old at the time. I know there's rules for that, but what if he's an only child? What can the parents do with the 529 plan if their kid doesn't need the money?
Yeah. And matter of fact, that's what we have for Elliot. Elliot, by the way, my son's turned 18 today. So
Oh, happy birthday, Elliot. What's up?
yeah, that's right. That's right. Yeah. Gosh, it's a happy, sad moment, really.
Yeah, seriously.
It's
18.
crazy. As soon as he got a social security number, I opened a 529 plan for him and automatically started contributing, being my own financial advisor.
Yeah.
Here are the options for Elliot is that we can transfer it up to first cousins. Now, I love my nephews, but I'm probably not going to do that. I do. I love them. They're wonderful. But so you could transfer that up to first cousins. You can also, if you were to take the money out, you could take the money out and you pay taxes and a 10% penalty on the gains only. On the gains only. So let's just say you put 10 grand in and it grew to 20, you pay taxes and a 10% penalty on the $10,000 worth of gains only. Okay. Now, what I visualize this happening now? So let's just say Elliot gets some type of certification later on in life. Okay. Or like you said, he could be an electrician or whatever the case may be. If there's any cost associated with that, it could be a qualified expense. Okay. But let's just say all of that's minimal. He could use that. He can keep that. He could be the successor owner of that 529 plan.
Okay.
And use it for his future children.
Oh,
that's right.
Wow, I did not know it had that longevity.
Yeah, that's right. So it could be like an educational legacy.
Wow.
Yeah.
That's huge.
That's right. That's right.
Okay.
That's right. Yeah.
Cool.
It's really, really beneficial to have this pot of money earmarked for educational expenses. And the penalty to come back out of it is not dramatic. You're paying taxes and a penalty on the gains only. I mean, whereas you'd be paying taxes along the way on the gains if you didn't invest in it.
Exactly.
So there'd be a 10% penalty is not too terrible.
Yeah.
And truthfully, I have never seen anybody pay a penalty on within 25 years. I've never seen it.
Yeah. Okay. All right. What else I know I've derailed you a ton on this podcast, man.
But you know what?
Answered so many great questions.
I'm flexible. I'm flexible. I'm maneuverable.
And now that you're dieting, you're more flexible.
I got more space in my waistband. But hey, I started 3 hours ago, so I didn't. Okay. It's not like
it's early in.
It's early in. That's
we'll check back at the next podcast.
Yeah, you're getting grumpy, Jeremy, right now. You're getting hungry, Jeremy. But the other thing to consider for the business owners out there is, take a look at what kind of type of retirement plan you have for your work. Some people they're doing their regular $6,000 IRA accounts. The upgrade from that is a simple IRA. It's a pretty inexpensive way to save $13,000, $14,000 a year in a plan. Or you can upgrade to a 401k. There's different levels and sophistication in the amounts you can contribute to your retirement plan, both for yourself and your organization. Really taking a look at what might be best for you, okay, and your employees. Employee retention. Hey, it's a competitive marketplace out there right now for good employees, and so a lot of them are looking for great benefits and really taking a look at that.
All right. Great information. Did we miss anything?
I'm missing the ice cream and the cheeseburgers that I'm used to eating. That's what I'm
3
missing.
hours, man. How much ice cream do you eat in the morning?
The morning milkshake.
That's true. Okay. Yeah. Okay. I get it.
So,
all right, my man. This has been a fantastic podcast. Thanks for answering all my questions.
Yeah.
If the audience still has questions, because of my brain doesn't always work the same every day,
Yeah.
but if their brains are going, man, why didn't you ask this? How do they get a hold of you so they can ask those questions?
Yeah, you can always give me a call at 843-970-1049, or you could email me at jeremy@riverbendwm.com. Obviously, if you check out Riverbend Wealth Management on Google, just put it in your Google search, Myrtle Beach, South Carolina. That should come up. Take a look at the website. Take a look at the blogs. We talk about a lot of this stuff. There's a search feature on the top right-hand side. You can type in whatever question or topic you want to know about. Obviously, find a podcast, blog topics, whatever's on your mind. And we're happy to answer your questions. No hard sales. We're just going to try to shoot you in the right direction, and you just go from there.
Yeah. Jeremy, again, thank you, man. Great time.
My pleasure, brother.
You bet. And our last thank you always goes to the listening audience. Thank you so much for tuning in and listening to the Retire Happy podcast with Jeremy Finger. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Jeremy comes out with a new podcast, it will show up directly on your listening device. And we humbly ask that you share this podcast, rate it, and leave a review, as this actually does help others find the show. So again, thanks for listening today. For everyone at Riverbend Wealth Management, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Retire Happy podcast with certified financial planner Jeremy Finger. If you have any questions, please visit us at www.riverbendwealthmanagement.com or call us at 843-970-1043. And remember, click the subscribe button below to be notified when new episodes become available.
Investment advice offered through Stratos Wealth Advisors, LLC, a registered investment advisor doing business as Riverbend Wealth Management. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.